A calm morning arrived when many people discovered their savings had suddenly shrunk without warning. Families who planned secure futures felt decades of effort slip away within just a few weeks. The summer of 1997 delivered one of the harshest financial shocks modern Asia had faced. Prosperity had seemed unstoppable as fast growth fueled confidence across several rising economies. Countries like Thailand and South Korea were praised as powerful engines of regional progress. Global investors rushed in, eager to capture returns from booming factories and expanding cities. New highways, ports and glass towers became symbols of rising ambition and visible wealth. Banks competed fiercely, offering generous loans with minimal checks on real repayment capacity. Easy money flowed toward property deals, luxury projects, and oversized corporate expansion plans. Many leaders believed growth would continue because previous years showed impressive momentum. Currencies were tightly linked to the United States dollar to signal stability to investors. That fixed exchange approach created comfort while hiding growing weaknesses beneath surface optimism. Businesses borrowed heavily in dollars because interest rates appeared lower than local options. Debt levels climbed quietly as profits seemed strong enough to cover future obligations easily. Speculative projects multiplied, including half-planned resorts, office parks, and prestige infrastructure ventures. Rising asset prices convinced many executives that risk management could safely be ignored. Warnings from cautious economists were dismissed as overly negative during a celebratory boom period. Thailand became the first nation where pressure began exposing cracks within the financial system. Its central bank spent large reserves trying to defend the baht's official exchange value. Officials hoped steady intervention would reassure markets and stop aggressive currency speculation attempts. However, traders noticed reserves declining while economic fundamentals appeared weaker than reported publicly. Large hedge funds started positioning against the baht, expecting the defense to eventually fail. They understood no central bank can spend reserves forever without damaging national finances. Speculative pressure intensified as more participants joined trades betting the currency would drop. Confidence faded quickly once investors realized official support could not last much longer. On 2 July 1997, authorities allowed the baht to float freely. The currency fell sharply within days, losing significant value against the dominant dollar. That sudden shift shocked global markets and triggered reassessment of regional financial stability. Investors feared similar weaknesses might exist inside neighboring economies with comparable debt structures. Money began leaving Indonesia, Malaysia, and South Korea as caution replaced earlier enthusiasm. Economists described this rapid spread of fear as financial contagion across connected markets. Like a chain reaction, one collapse increased pressure on others already carrying hidden vulnerabilities. Local citizens rushed to exchange savings for safer foreign currencies, especially the trusted dollar. Demand for dollars surged while domestic currencies weakened under relentless selling pressure. Import costs rose quickly because weaker currencies made essential goods more expensive overnight. Companies that borrowed in dollars suddenly faced debts far larger in local terms. A business owing $1 million now required much more local currency to repay. Balance sheets deteriorated as revenue remained local while obligations stayed fixed in dollars. Several large corporations declared bankruptcy after failing to service expanding debt burdens. Construction sites halted operations, leaving unfinished towers standing like reminders of excess optimism. Urban skylines across the region showed cranes frozen above silent concrete skeletons. Layoffs spread through manufacturing, banking, and property sectors as credit lines disappeared. Household incomes dropped, forcing families to cut spending on education and daily essentials. Small shops closed as customers reduced purchases to conserve limited remaining cash. Public frustration grew as unemployment rose and savings accounts delivered painful losses. Governments requested emergency assistance from international institutions to stabilize collapsing financial systems. The International Monetary Fund arranged large rescue packages tied to strict economic reforms. Conditions required budget cuts and structural changes intended to restore investor confidence. Many citizens felt these measures deepened short-term hardship despite long-term stabilization goals. Interest rates increased sharply to defend currencies and discourage further capital flight. Higher borrowing costs made it difficult for businesses to finance normal operations. credit shortages slowed production, trade, and hiring across multiple affected economies. Street-level reality showed longer job lines and quieter commercial districts than before. The crisis revealed how quickly optimism can transform into widespread anxiety during financial stress. Years of growth were reversed within months as asset prices and incomes declined together. Trust in local banks weakened, prompting additional withdrawals that intensified liquidity shortages. Authorities introduced guarantees and reforms to rebuild confidence in the banking sector. Over time, export industries benefited from cheaper currencies that improved global competitiveness. Recovery began slowly as disciplined policies reduced debt and strengthened foreign reserve positions. Several nations restructured financial supervision to monitor risky lending more carefully. Corporate governance standards improved, requiring clearer reporting and transparent balance sheets. Lessons from the turmoil reshaped how emerging markets manage capital flows and currency exposure. For individuals, the episode highlighted the danger of relying on a single economic environment. Keeping all savings tied to one currency can amplify losses during sudden devaluations. Diversification spreads risk across different assets, regions, and financial instruments over time. Holding a portion of wealth in international funds can reduce dependence on local cycles. Physical assets like gold have historically preserved value during periods of currency instability. Precious metals often attract demand when confidence in paper money begins fading. Maintaining some savings in strong reserve currencies can provide protection during volatility. When local money weakens, foreign holdings may offset part of the overall loss. Avoiding excessive debt during boom years reduces vulnerability when credit conditions tighten. Fixed-rate loans provide predictable payments even if central banks raise interest rates later. Variable-rate debt can become dangerous when borrowing costs jump during defensive policy moves. Monitoring a country's foreign reserves offers clues about its ability to defend currency value. Rapid reserve declines sometimes signal mounting pressure within the external balance. Understanding basic macroeconomic indicators helps individuals interpret warning signs before headlines escalate. Not every surge in prices represents genuine long-term economic strength. Bubbles are often driven by cheap credit and unrealistic expectations about endless growth. Sustainable expansion usually depends on productivity gains and competitive export industries. Separating hype from fundamentals requires patience and willingness to question popular narratives. The events of 1997 proved even admired economies can face severe instability. Strong growth records do not guarantee immunity from poor financial management decisions. Building an emergency fund covering 6 months of expenses creates a personal safety buffer. Liquid savings allow households to manage disruptions without selling long-term investments at losses. Chasing unusually high returns without understanding risks can expose savings to downturns. If an opportunity sounds effortless, hidden dangers may exist beneath attractive promises. Many investors during the boom ignored caution because profits appeared easy and consistent. Greed can cloud judgment. Encouraging larger bets than personal risk tolerance should allow. Maintaining discipline during prosperous periods is essential for long-term resilience. Calm decision-making becomes difficult when headlines amplify fear across markets. Reacting impulsively during panic often locks in losses that patience might reduce. Waiting for clearer information before major moves can prevent costly emotional mistakes. History shows affected Asian economies eventually recovered and rebuilt stronger foundations. Governments accumulated larger foreign reserves to defend against future speculative attacks. Banks adopted stricter lending standards and improved risk assessment procedures. Export-focused strategies helped generate steady foreign currency earnings over subsequent years. Households gradually rebuilt savings as employment stabilized and wages improved again. Resilience came from policy reforms combined with determination from workers and entrepreneurs. Individuals can apply similar principles by strengthening personal balance sheets during good times. Consistent saving habits create flexibility when unexpected expenses or income shocks occur. Investing in education improves earning potential and financial decision-making across changing markets. Understanding basic investing concepts helps identify unsustainable trends before they become dangerous. Financial systems evolve, introducing new products that may carry unfamiliar hidden risks. Strategies successful in one decade may underperform when conditions shift dramatically later. Adaptability allows investors to adjust allocations as interest rates and growth change. Long-term planning should include scenarios where markets experience prolonged downturns. Stability often feels permanent during expansions, yet cycles eventually reverse without warning. Economic history repeatedly shows alternating periods of growth followed by contraction. Preparing during prosperous phases is easier than reacting after losses have occurred. Building diversified portfolios takes time, discipline, and consistent contributions over many years. Exploring international markets can reveal opportunities uncorrelated with domestic performance. Following the crowd into fashionable assets frequently ends with late buyers absorbing losses. Independent research and data-driven decisions reduce reliance on emotional market sentiment. Clear investment rules help maintain consistency when volatility tempts sudden strategy changes. Protecting capital should remain a priority alongside pursuing reasonable long-term returns. A balanced approach considers liquidity needs, risk tolerance, and future financial goals. Households benefit from tracking expenses to understand how much cushion truly exists. Budget awareness prevents overextension during periods when credit is easily available. Emergency planning includes insurance coverage for health, property, and income disruptions. Multiple income streams can provide resilience if one source declines unexpectedly. Simple habits like automatic savings transfers encourage consistency without daily effort. Reviewing portfolio allocations annually ensures positions still match changing life circumstances. Tax-efficient investing preserves more returns by minimizing unnecessary leakage over time. Keeping documentation organized helps families access funds quickly during urgent situations. Open conversations about money reduce stress and align expectations among household members. Teaching younger generations basic financial literacy builds stronger decision makers for the future. Understanding currency risk becomes increasingly important in a globally connected economy. Even local jobs can be affected by exchange rates through trade and capital flows. Awareness of global events helps individuals anticipate potential ripple effects on domestic markets. Reliable information sources are essential during fast-moving economic developments. Sensational rumors often spread quickly and can trigger unnecessary panic reactions. Cross-checking data from multiple credible outlets improves confidence in chosen actions. Long-term wealth typically grows through steady compounding rather than sudden speculative wins. Patience allows investments time to recover from temporary declines. Rebalancing portfolios periodically locks in gains and prevents excessive concentration risk. Holding some cash reserves provides flexibility to seize opportunities during market dislocations. Value often appears when others are forced sellers due to liquidity pressures. Risk management means accepting that losses are possible despite careful preparation. Diversified exposure across equities, bonds, commodities, and cash can smooth overall performance. Avoiding leverage in personal portfolios reduces the chance of forced liquidation. Regular reviews of debt obligations ensure repayment schedules remain manageable. Maintaining good credit history improves access to affordable financing when necessary. Emergency plans should include steps for temporary income loss or unexpected medical costs. Community support networks can provide assistance during widespread economic hardship. Stronger banking capital requirements reduce the probability of systemic failures. Continuous vigilance remains necessary as innovation introduces new channels for instability. Digital capital flows move faster today, increasing the speed of market reactions. That reality makes personal preparedness even more valuable for everyday savers. Keeping goals clear helps resist distractions from short-term market noise. A written financial plan provides direction during both optimism and uncertainty. Consistent habits, clear goals, and patience form the foundation of lasting financial security. By studying history, investors gain perspective on how quickly sentiment can shift. Building buffers today ensures tomorrow's challenges do not erase years of hard work. Steady preparation turns unpredictable markets into manageable environments rather than overwhelming threats.